Something bizarre is happening with XRP that most retail investors aren't paying attention to, and it's creating one of the strangest divergences I've ever seen in crypto markets. We're in February 2026, and institutional money is pouring into XRP at a pace that would normally send prices parabolic. Instead, XRP is trading around 144 after dropping 25% from recent highs and over 50% from its July 2025 peak of 3.65. The question everyone should be asking isn't whether institutions are buying XRP, because the data proves they absolutely are. The question is why that institutional buying hasn't translated into price appreciation yet, what that divergence tells us about market structure, and whether this represents the opportunity of the year or a value trap that's about to get worse. Let me give you the numbers that don't make sense at first glance. 7 U.S. spot XRP ETFs launched in mid-November 2025, and as of February 12, 2026, they collectively hold approximately $1 billion in assets under management, with 795.9 million XRP tokens locked in institutional custody. Cumulative net inflows since launch exceed $1.37 billion, according to multiple tracking sources, making XRP the second fastest crypto ETF to cross the billion-dollar threshold after Bitcoin itself. In just the first week of February, XRP ETFs absorbed $51.3 million net inflows, while Bitcoin, Ethereum, and Solana ETFs all registered net outflows during the same period. On February 6 specifically, XRP ETFs saw $16 million in daily inflows, led by Bitwise with $8.29 million, Franklin Templeton with $394 million, and Canary Capital with $293 million. The consistency is what stands out. XRP ETFs went 43 consecutive trading days without a single net outflow after launch, a streak that Bitcoin and Ethereum ETFs couldn't match during their comparable periods. Even as price dropped throughout January and early February, institutional flows remained positive or flat nearly every single day. This isn't retail speculation that buys during pumps and panics during dumps. This is mandate-driven institutional allocation that executes regardless of short-term volatility based on approved investment policies and strategic asset allocation models. When pension funds and asset managers receive approval to allocate a certain percentage of portfolios to digital assets, they deploy that capital systematically through VWAP algorithms over weeks and months, completely disconnected from daily price action or social media sentiment. Now here's where it gets strange. During December 2025, when XRP ETFs absorbed $483 million in net inflows, Bitcoin ETFs hemorrhaged $1.09 billion, and Ethereum funds lost $564 million. XRP was the only major crypto asset seeing sustained institutional buying, while everything else experienced massive redemptions. That capital rotation from Bitcoin and Ethereum into XRP wasn't driven by retail FOMO. Retail doesn't move hundreds of millions between ETF products. This was large institutional allocators making deliberate reallocation decisions based on risk-adjusted return expectations and regulatory positioning. They looked at the entire crypto landscape after the SEC's August 2025 settlement, with Ripple eliminated legal uncertainty around XRP's status, and they made a calculated bet that XRP offers better risk-reward than older, more established digital assets. The regulatory clarity matters enormously, and most retail investors don't fully appreciate why. When the SEC lawsuit against Ripple Labs was finally settled in August 2025, with the court determining that XRP is not a security when sold in programmatic public retail transactions, it removed the single largest barrier preventing institutional adoption. Before that settlement, compliance departments at banks, asset managers, pension funds, and insurance companies couldn't approve XRP exposure because the legal risk was unquantifiable. One adverse court ruling could have reclassified the entire asset as an unregistered security, creating massive liability exposure for any institution holding it. After the settlement, that existential risk disappeared, and suddenly XRP became one of the only major crypto assets with explicit regulatory clarity in the United States market. That clarity is what unlocked the flood of ETF approvals. Within months of the settlement, 7 different issuers, including Canary Capital, Franklin Templeton, 21 Shares, Bitwise, Grayscale, WisdomTree, and VanEck, all launched US spot XRP ETF products. In Asia, Hashkey Capital launched Hong Kong's first XRP tracker fund. In Europe, WisdomTree rolled out physically backed XRP ETPs trading on Deutsche Börse Xetra, SIX Swiss Exchange, and Euronext. This wasn't gradual adoption over years. This was simultaneous global infrastructure build-out by the largest asset managers in the world, who had been waiting in regulatory purgatory for years to offer these products to their clients. The pent-up demand from both issuers and institutional allocators created the explosive inflow pattern we're witnessing. Vanguard opening XRP ETF access to its 50 million clients represents a watershed moment that most people haven't fully processed yet. Vanguard manages over $7 trillion in assets and has historically been extremely conservative about crypto exposure, refusing to offer Bitcoin ETFs for years after launch due to volatility concerns and philosophical objections to speculative assets. For Vanguard to approve XRP exposure signals institutional acceptance at the highest levels of traditional finance. Their client base isn't day traders or crypto enthusiasts. It's retirement savers, pension funds, endowments, and conservative long-term investors who think in decades, not days. When that demographic gains access to an asset through a platform they already use and trust, it creates steady, relentless buying pressure that compounds over years as accounts systematically rebalance and allocate small percentages to new asset classes. CME Group launching XRP futures in late 2025 provides another piece of institutional infrastructure that matters more than retail realizes. CME is the largest derivatives marketplace in the world, and they don't launch futures contracts for assets they believe will disappear in a few years. Futures serve two critical functions for institutions. First, they allow hedging of spot positions, which means institutions holding physical XRP through ETFs or direct custody can now hedge downside risk through futures, making the asset far more palatable for risk committees and compliance departments. Second, futures provide price discovery and liquidity depth that makes the market more efficient and reduces the impact cost of large institutional orders. You don't build comprehensive derivatives infrastructure for speculative trades. You build it for assets you expect to be major portfolio components through multiple market cycles. Now let's address the elephant in the room that everyone's confused about. If institutional demand is this strong and sustained, why is price getting destroyed? XRP dropped from $2 in early January to $1.44 by early February, a 28% decline in less than 5 weeks. It's down over 60% from the $3.65 highs reached in July 2025. The technical structure looks broken with price trading below all major moving averages, RSI and oversold territory, and resistance levels that have capped every rally attempt. Exchange-held XRP balances collapsed to 7-year lows of approximately 1.6 to 1.7 billion tokens as ETF custodians and long-term holders withdrew supply from liquid trading venues. Yet price keeps declining despite this apparent supply shock. How does institutional buying and supply compression coexist with a 60% drawdown? The answer lies in understanding market structure and the different forces acting on price simultaneously. ETF inflows represent steady, systematic buying that creates a bid floor and prevents catastrophic collapse, but they don't create explosive upward momentum because the capital comes in gradually through algorithms designed specifically to minimize market impact. When a pension fund allocates $50 million to XRP through an ETF, that purchase happens over days or weeks through VWAP orders that slice the total size into thousands of small increments spread throughout each trading day. The goal is to match the volume-weighted average price without moving the market, which means by design, ETF buying doesn't create visible pumps. It creates invisible support that you only notice when price holds levels during broader market sell-offs that would normally create much deeper corrections. Meanwhile, other forces are actively pushing price lower. Leveraged long positions built up during the Q4 2025 rally, when XRP ran from under $1 to over $3, have been systematically liquidated throughout January and February as volatility and funding costs made maintaining those positions untenable. Derivatives open interest on XRP dropped from approximately $3.8 billion to lower levels as forced liquidations cascaded through the system, with each liquidation triggering more selling that pushed price lower and caused the next tier of margin calls. This mechanical selling from leverage unwind has nothing to do with fundamentals or institutional conviction. It's purely technical pressure from over-levered positions getting flushed out of the system. Broader crypto market sentiment has been deeply negative throughout early 2026 as macroeconomic conditions deteriorated. U.S. unemployment rose to 4.4%, consumer debt hit record highs, and risk appetite collapsed across all speculative assets as recession fears intensified. When Bitcoin drops 30% to 40% from its peaks, altcoins, including XRP, typically decline 50% to 70%, regardless of their specific fundamentals because they trade as high beta risk assets with strong correlation to broader crypto markets. Retail investors who bought XRP during the late 2024 and early 2025 rally based on hype and FOMO have been panic selling throughout the correction, overwhelming the steady institutional bid with waves of emotional capitulation selling that feeds on itself as price breaks key support levels. Ripple's monthly escrow releases add another layer of complexity. Ripple holds approximately 45 billion XRP in escrow with scheduled monthly unlocks that release tokens according to predetermined schedules. While Ripple typically relocks unused tokens and has been a relatively disciplined steward of this supply, the existence of this overhang means potential selling pressure looms over the market constantly. If Ripple needed to liquidate several hundred million XRP over a short period for operational expenses, treasury management, or strategic initiatives, that volume could overwhelm institutional ETF demand and crater price regardless of long-term fundamentals. The market prices in this tail risk through lower valuations than would exist if supply were completely fixed and predictable. The divergence between institutional flows and price action creates what professional traders call a structural dislocation, and these dislocations don't resolve linearly. They build tension until one force overwhelms the other, then price adjusts violently to reflect the new equilibrium. Right now, we're in the tension building phase where ETF buying is absorbing supply and creating a floor somewhere between $1.40 and $1.50. But leverage selling, retail panic, and macro headwinds are preventing any sustainable rally above 160 to 170 resistance. This standoff could persist for weeks or even months, with price grinding sideways in an increasingly tight range as supply gets locked up while demand remains tepid. The resolution depends entirely on which force wins. If ETF inflows accelerate from current levels around $50 million per week to $100 million or $200 million per week as more institutional mandates approve XRP allocations, and if leverage flush is complete so mechanical selling pressure dissipates, and if broader macro conditions improve through Fed rate cuts and stabilizing economic data, then the supply compression finally translates to upward price pressure as buyers overwhelm available sellers. In that scenario, price could move extremely fast once it breaks through key resistance because the lack of liquid supply means small increases in demand create disproportionate price impact. This is the bull case that has long-term holders excited despite current pain. Alternatively, if ETF flows fade as initial allocation mandates complete their deployment and no new institutional capital arrives, and if recession materializes causing risk appetite to collapse further, and if crypto winter conditions persist through 2026 with Bitcoin potentially dropping to $40,000 or lower, then XRP could easily test $1 or below regardless of how much supply is locked in ETFs. Infrastructure value and market price don't move in lockstep, and assets can trade significantly below fair value for extended periods when sentiment is negative and liquidity is scarce. This is the bear case that skeptics point to when arguing the institutional narrative is overblown and XRP is just another altcoin that will get crushed in a sustained downturn. The data from the first week of February provides some clues about which scenario is more likely playing out. XRP ETFs absorbed $51.3 million in net inflows, while Bitcoin, Ethereum, and Solana all saw outflows, suggesting institutional capital is still rotating toward XRP as a preferred allocation, even amid market stress. Franklin Templeton and Bitwise, two of the most sophisticated institutional asset managers in the world, each deployed approximately $20 million into their respective XRP ETFs during this period. That concentration of flows into products from established issuers rather than spreading across all 7 ETFs indicates high conviction positioning by knowledgeable institutions who've done extensive due diligence. The Ripple Community Day event held February 11th to 12, 2026 provided additional validation as institutional leaders, payment providers, and ecosystem partners gathered to showcase real-world use cases and Ripple's 2026 roadmap. These events matter because they build trust and visibility, converting speculative interest into concrete partnerships and investment decisions. When banks and payment processors see competitors successfully deploying XRP-based solutions and hear directly from Ripple leadership about scaling initiatives, it accelerates adoption timelines and de-risks the technology in the eyes of conservative institutions who need social proof before committing capital to emerging infrastructure. Ripple's RLUSD stablecoin represents another institutional adoption vector flying under retail's radar. Launched in December 2024 with minimal fanfare, RLUSD has grown from $72 million market cap at launch to $138 billion as of early 2026, representing approximately 1,800% growth in roughly 1 year with over 37,000 holders. This isn't retail speculation. This is institutions using RLUSD as high-quality collateral for cross-border settlement, treasury management, and as a liquidity vehicle within the XRP ledger ecosystem. The significance is that RLUSD creates a regulated fiat on-ramp directly connected to XRP infrastructure, allowing traditional financial institutions to move dollars on-chain without touching unregulated stablecoins or navigating compliance nightmares that come with USDT or USDC in certain jurisdictions. The cross-border payments narrative that Ripple has been building for over a decade is finally transitioning from pilots to production at scale. Ripple's on-demand liquidity product using XRP as a bridge asset for real-time cross-border settlement processed billions in transaction volume throughout 2025, Major financial institutions, including Japan's SBI Holdings, Middle Eastern banks, and Southeast Asian payment providers, are using ODL in live production environments to settle payments in seconds rather than 3 to 5 days required by traditional SWIFT infrastructure. Standard Bank ran successful pilots. Shinhan Bank completed stablecoin remittance tests. These aren't press releases about future potential. These are banks that tested the technology, saw it work, and moved forward with production deployments. The 150 trillion annual global payments market is beginning its slow grinding transition from correspondent banking networks that require pre-funded Nostro accounts in destination currencies to real-time blockchain settlement rails that eliminate that capital inefficiency. XRP has positioned itself as the neutral bridge asset for this transition through years of relationship building with banks, payment processors, and regulators. The technology works, the energy efficiency is orders of magnitude better than proof-of-work chains, the transaction finality happens in 3 to 5 seconds, and costs are fractions of a cent per transaction. These aren't speculative claims, these are verifiable operational characteristics proven through years of production usage processing billions in real value. Now let's talk about the BlackRock elephant that everyone's whispering about. Rumors suggest BlackRock may file for an XRP ETF in late 2026 or early 2027, and while nothing's confirmed, the sheer scale of BlackRock's $14 trillion in assets under management means any filing would instantly legitimize the asset class and unlock a flood of passive capital. BlackRock's Bitcoin ETF became the fastest growing ETF in history by accumulating over $40 billion in assets, demonstrating their ability to mobilize capital at unprecedented scale through their Aladdin platform that connects thousands of institutional investors. Even as a rumor, the possibility creates forward-looking positioning where other asset managers accumulate ahead of potential BlackRock entry, not wanting to be caught underweight if and when it materializes. The concentration of ETF flows into Franklin and Bitwise products specifically is telling. These aren't random allocators. Franklin Templeton manages over $1.5 trillion and has been actively building blockchain infrastructure and tokenization capabilities for years. Bitwise pioneered crypto index products and has deep relationships with registered investment advisors and wealth management platforms. When these sophisticated institutions deploy $20 million each into XRP ETFs during market weakness while others see redemptions, it signals conviction based on proprietary research and client demand, not momentum chasing. They're positioning for where institutional demand will be in 12 to 24 months, not where sentiment is today. The technical setup creates interesting risk-reward asymmetry for those willing to think in quarters rather than days. Support has formed around 140 to 150, where ETF buying and long-term holder accumulation creates a bid. The psychological $1 level represents catastrophic support where panic would likely trigger before stabilizing. On the upside, resistance sits at 1.69, where previous support turned into ceiling, then $2 as a psychological barrier, and 228 to 2.30, where significant liquidations occurred during January's decline. A decisive break above 2.30 with sustained volume would invalidate the bearish structure and open pathways toward $3 to $4 over subsequent months as shorts cover and sideline capital re-enters. The most transparent demand signal available is ETF flows, and they need to be monitored obsessively because they provide real-time insight into institutional conviction. Monthly inflows above $300 million indicate robust mandate-driven buying continuing. Significant drops below $150 million for multiple consecutive months would signal that initial allocation wave has exhausted and new catalysts are needed to resume accumulation. As of early February, flows remain solidly positive around $200 million to $250 million monthly, which is healthy but not explosive. The key is watching for acceleration or deceleration in coming weeks. Standard Chartered's Jeffrey Kendrick projects XRP reaching $8 by year-end 2026, implying over 400% gains from current levels around $150. His model assumes sustained ETF demand growing to $4 billion to $8 billion in cumulative inflows by year-end, RLUSD gaining significant traction in Asian banking corridors, creating recurring XRP demand, and supply compression from exchange withdrawals, creating structural scarcity as approximately 1% of circulating supply gets absorbed monthly by ETFs. The bullish scenario requires ETF inflows above $300 million monthly, major banks announcing XRP treasury holdings, RLUSD scaling to multi-billion-dollar market cap, and supportive macro conditions with Fed rate cuts boosting risk appetite. If those conditions align, $5 to $8 becomes mathematically plausible based on supply-demand mechanics. The base case clusters around 2i50 to 350 by year-end, assuming steady ETF inflows of $200 million to $300 million monthly without explosive acceleration, continued exchange supply decline creating moderate scarcity, RLUSD adoption in 2 to 3 Asian payment corridors, and neutral macro conditions where neither recession nor euphoria dominates. This outcome requires execution but not perfection, assuming current trajectory continues without major disruptions or extraordinary catalysts. Conservative models peg $2 to $3 as realistic given historical resistance near the 384 all-time high from January 2018 that XRP hasn't broken in over 8 years. The bearish scenario places XRP between $1 and $1.50 through 2026 if multiple headwinds converge, recession hits and risk appetite collapses, ETF inflows dry up as institutional mandates get pulled, RLUSD fails to gain adoption beyond niche use cases, regulatory uncertainty reemerges. Under sustained pressure, XRP could spend the year building institutional ownership while price reflects fundamentals constrained by unfavorable conditions. This isn't prediction, but realistic risk that position sizing must account for. The honest assessment is that institutional adoption is real, substantial, and accelerating based on verifiable ETF flow data and named partnerships with major financial institutions. The regulatory clarity post-SEC settlement created the conditions for this adoption wave. The technology works and solves real problems in cross-border payments. The governance and energy efficiency make XRP appealing to ESG-focused mandates. All of this is true and bullish long-term. Simultaneously, price is getting crushed by leverage liquidations, retail panic, and macro headwinds that create brutal short-term conditions regardless of fundamentals. Both things are true at once, and that creates the divergence we're witnessing. For long-term investors who can stomach volatility and think in years, the current setup of strong institutional buying during price weakness is exactly the pattern that precedes major bull markets once conditions shift. Institutions accumulated Bitcoin throughout 2019 and 2020 while price ground sideways between $6,000 and $12,000. Then price exploded to $60,000 when conditions turned favorable. The pattern repeats across asset classes. Smart money accumulates during fear. Retail chases during euphoria. We're clearly in the accumulation phase based on ETF data showing consistent buying despite price pain. The critical question for anyone considering XRP exposure is whether you're trading or investing. Traders should avoid this choppy environment where technical structure is broken and momentum is negative. Wait for clear signs of reversal above $1.70 with sustained volume before entering. Investors who believe cross-border payments transition to blockchain rails over the next decade and XRP has positioned itself as infrastructure for that transition should use current weakness to systematically accumulate through dollar cost averaging, understanding that another 20% to 30% downside is possible before recovery begins. Position sizing matters more than timing. Only deploy capital you can afford to lock up for years without stress. The infrastructure is being built right now during maximum pessimism and price depression. That's always been how generational wealth gets created in markets. You buy quality assets that are fundamentally sound but temporarily out of favor. Then you wait for recognition to catch up to reality. XRP has the institutional adoption, regulatory clarity, real-world utility, and systematic buying that characterize quality infrastructure assets. It also has brutal technicals, negative sentiment, and macro headwinds that create pain for holders. Reconciling those contradictions requires conviction and patience. The institutional money is voting with billions in capital flows. The question is whether retail investors can see through the noise and position themselves accordingly before the next phase of adoption makes the opportunity obvious to everyone. This analysis is for informational purposes only and should not be considered financial advice. Cryptocurrency markets are highly volatile and speculative. Always conduct your own research and understand your risk tolerance before making investment decisions.